I hear people saying positive things about Doge and talking about how to dividend things already. It just sounds insane. Back in the 1940s, even before the World War II environment, we were holding somewhere close to 40% of US gold reserves. And today we're about 2%. Gold reserves are at a 90-year low in the US and then a 50-year high in international central banks. My question is, when is the US gonna choose the moment to participate again on this buying spree? Clearly, they're missing out and they know they are, and there's a reason where we're seeing executive orders making gold a critical metal again.
Before we get started, this isn't financial advice. Know your risk tolerance, do your own due diligence, and speak to a financial advisor. All right, welcome back to another pod. The markets are shaky with the fear index now at multi-year highs. The US dollar is showing signs of peaking, and there's potentially a very powerful rotation brewing in the markets, one that could send commodities and possibly emerging markets into bull market territory. For natural resource investors like myself, I think this could be one of the most interesting setups we've seen in years. Today's guest is someone I've been looking forward to having on for some time. Tavi Costa, macro strategist, Crescat Capital, one of the sharpest minds out there in my view when it comes to macro investing and the world of commodities. Before he was breaking down markets and guiding portfolio strategies, Tavi was a NCAA Division I tennis player, and that same relentless focus on the courts, I think he carries with him into the capital markets. So today we're going to talk about his journey growing up in Brazil to becoming a go-to voice in the precious metals world, his outlook, of course, for gold and silver, and how Trump's policies may help shake things up in the mining space. So Tavi, welcome to the pod.
Well, thanks for the intro. Very kind of you, and looking forward to this.
My pleasure. You've been making some pretty interesting calls lately about gold and silver and other commodities and where they may be headed. But before we dive into that, I want to just rewind a bit. I like to get a little bit of a backstory. You're originally from Brazil, Sao Paulo, I believe. You made it to the US and ended up playing Division I tennis, and then somehow found your way into the world of precious metals and macro investing. Walk us through that journey. Was there a particular moment or influence in your life that kind of lit a fire to jump into the world of finance?
A lot of things. I think money has always been sort of different cycles we've been through with my family. My family was, when I grew up, my dad owned a small business and it was doing quite well, up until my early teenager times. And then things kind of went south and basically his business went bankrupt. So I saw sort of money as kind of a safety aspect of it rather than a showing off position for most people. And so I saw my parents go through a very, very difficult period. One thing is to lose everything you have in the US. Another thing is to go through that in an emerging market. So for me, money has always been, again, a way of, when I think of my family and my, not just my core family, my wife and my daughter, but also my bigger family, I think of, what's my optimal way to secure the finances of everyone involved. And so this has always been in my head. So I got involved with the business, my parents' business very early on, helping them in any way I could. That also helped me to, think about my life in general and ways to sort of escape that situation that we were in that position at that time. So I learned a lot about business very early on, but from an entrepreneurial standpoint, not so much from a finance standpoint, but it helps once you get involved with investing. And then got into tennis. Tennis was sort of my outlet and my bridge to get into the US. My parents didn't have any money, so I couldn't really afford coming to the US, especially earning money in reais. And spending in the US was just impossible. And tennis was a good way to get a scholarship and a free ride essentially to come to the US and earn my college education. That was really a way to escape. And then when I got here, I fell in love with investing, the investing sort of dynamics. I took a class on investments and start learning about how to allocate capital very early on. And then that went from that to reading newspapers on a daily basis. There was a routine that I had, that I was reading all sorts of newspapers from the right, from the left, and very market-oriented things. And so by the time when I was in my kind of early 20s, I was very market savvy. I knew all the terms. I knew what was going on with central banks. I had opinions already. I was forming opinions at the time and learned very early on the humility aspect of markets. So all these things kind of add on, and eventually I got the opportunity to work at a hedge fund. And once I started working there, this was my dream job, right? I mean, getting paid to learn about the world. Everything was about emerging markets. And then I start learning more about global macro. Global macro became a big thing for me, and I sort of went from there to developing, thematic ideas to invest, learning more and more about different investors, start to share my opinions on social media. Things that started to get around, and then 2018, 2019 began to really form a view about natural resources because of my research mostly on how CapEx for most of the producers was really depressed at that time. So I was kind of actually one of the first people really putting that type of research back in early 2018, 2019. And then the question became, how do I express that in the markets? And that's when things got a lot deeper with partnerships and the learning curve of how to deploy capital in the mining industry specifically, and other natural resources too, and that learning curve of that whole industry itself. So lots of things until I got to gold specifically, and precious metals and base metals. But I'm not a gold bug, I'm a macro guy, but I can see this as a sort of a 10, 15 year cycle that we may be entering here for this industry in particular.
So I'm just one more question on your upbringing. It's interesting because I've obviously born and raised in Canada. I've lived in the States for a period of time, and being raised in Vancouver, I was always around the commodity world, the mining world. So it's kind of deep, I guess you could say, in my blood. But in Brazil, now obviously it's an emerging market, but obviously very reliant on commodities as well. Growing up there, are you kind of exposed to the value of investing in commodities like we are here in Canada, or is it just kind of overlooked there? Like, how did you get your natural penchant to want to focus on natural resources?
Not so much, I guess, from my upbringings, I guess. Well, there's a few of that, but my dad is also owned a retail business in clothing for kids that basically lost most of its business to Chinese exports,
right.
And that basically killed his margin at the time. Then he refocused back into a farm that he inherited from my grandfather, small little operation. So that's where I guess I was involved in some of the natural resource space, but not really. I mean, I always knew that the Brazilian economy had a strong link to commodities, but didn't know exactly how that link was done and exactly which commodities had the strongest correlation with the markets in Brazil. But I think that my biggest, maybe similar to you, maybe my biggest understanding of things was through inflation. Learning that inflation has always been a problem in emerging markets. So I had mindset of thinking about, I'm holding cash, I'm losing money. So that was early on to me. When I moved to the US, I understood that only after COVID and after all these, easy policies that we've had over the last few years, that kind of caused people to change their mindset about holding cash and learning about inflation. Yeah. And I guess I was lucky to, or maybe not, I wouldn't call myself lucky, but certainly I had that experience early on in my life, and hearing stories even from my dad, holding a motorcycle rather than holding cash and actually making money on that. And in the US, that would be unheard of until recently, when we saw used price of cars actually going up substantially. Yeah. And so, and not necessarily linked to natural resources, but I think inflation was a bigger story in my life than other things.
Yeah, likewise. So on that subject, now you've been calling for a potential peak in the US dollar and a powerful sort of rotation coming. Can you break that down? Like, what do you mean exactly? Because I've heard your thesis on this. I agree, and I think it's super interesting. But if the dollar really is peaking, what kind of opportunities do you think that opens up for commodities and emerging markets?
Yeah, I think the dollar is become such an important kind of a central piece of at least my views. Gold and hard assets were certainly, but what changed was research I was looking at, especially how we're reaching a point where government spending is such a large percentage of GDP that in order to reduce that, you really need to reduce interest rates, because that's the servicing aspect of the debt has become such a large percentage of GDP that the biggest impact you can have in austerity is actually by reducing rates. And, naturally when you research those combinations of policies, when you get austerity and lowering rates types of movements, those usually have a very negative impact on the dollar versus other currencies, particularly if all else is equal, which may even be even different on the other side of it. That's one aspect. The second aspect was, okay, well, if the U.S. has to lower rates, what's the position of the U.S. in terms of interest payments to GDP versus other countries in the world? And then you get to a point where you start learning that the U.S. is, well above any other country. So we're about approaching close to 5% of federal and local debt, interest payment relative to GDP, while other places, Japan and most European countries, Canada and so forth, are substantially lower. In some cases, the U.S. is 3, 4, 5 times higher than other economies. And so the sense of urgency from the U.S. policymakers to lower rates is much greater than other places. And so that interest rate differential that the U.S. may reduce rates much faster than other countries can translate into another impulse on the FX side of it, of appreciating other currencies relative to the US dollar. Okay, that's kind of like the sort of the mechanism on the policy making front. But then you start seeing, the valuation of the dollar as well there's a really good index that looks at, it's a trade-weighted real sort of exchange rate that the Fed actually puts out, that you can look at that going back all the way to the 1900s. And the US dollar has really been this expensive only 2 other times in history, which was 1985 and 1933. And those other 2 times are, had very different sort of outcomes to devalue the US dollar versus other currencies. One was more coordinated. Central banks got together in 1985, the Plaza Accord, and reduced the dollar valuation versus other fiat currencies. And that kind of inflated the rest of the world. You saw the Japanese bubble sort of inflate during that time all the way to the 1990s. And that's really on the back of money flowing out of the dollar into other countries. And then you saw 1933, which was a very different environment. We're in the middle of the Great Depression. In 1931, a lot of economies broke their peg. The gold peg kind of lost their gold standard. That caused the US dollar to rally versus those currencies. You were talking about UK, Canada, Germany, some pretty large economies. And then eventually the US had to do the same. And that was the peak of the US dollar in 1933. And so in my view, we're reaching a peak of the dollar. Another chart that I thought or analysis that was very relevant, is that the dollar curve over the history has a really strong correlation with the relative performance of U.S. equities versus the rest of the world. And to be specific, there's over 0.8 correlation when you do 10-year rolling changes of the dollar versus that relative performance of the S&P versus the MSCI world. Clearly when the dollar turns, you tend to see these really long-term sort of cycles, and that's how currencies work. Currencies take a long time to kind of make that turn, but when it happens, it kind of establishes a decade-long type of investment opportunity that you got to pay attention to. And in my view, there's a lot of signs of things turning, but also a lot of signs of how things are really extreme that could, kind of exacerbate this opportunity potentially. You have U.S. equities, in terms of weights, equity markets extremely high versus the rest of the world. You have even within the U.S. economy, tech being really high and Next 7 being really high versus the rest of the market. And so all these things are kind of the risk that you have. And then you have the other side of it where emerging markets have been neglected for a long time, have not received any flows whatsoever. Now the turn of European equities and Japanese equities, you got Warren Buffett investing in Japanese businesses, and David Tepper coming out and talking about Chinese equities. And so you kind of see that things are starting to move in that direction. So I think there's a big early stage sort of development unfolding in front of us that we may see U.S. equities really underperform other parts of the world. And to just finalize that whole answer is that there's 2 things that really hurt commodities in emerging markets and other economies: rising yields in the U.S. which attracts people to invest in treasuries and all sorts of things, or is a rising dollar, right? If the rise of the dollar is substantial, it basically hurts the other currencies, and investors tend to go back to the US dollar, and that also creates a reflexivity on US equities and assets and so forth. The so-called milkshake theory from Brett Johnson. And I think we're on the other side of this now. If you cap yields and cap the dollar, then you create sort of a green light to emerging markets. It's a very different world when you think with those lenses, and I think we're entering that in my view, and that's why I'm so focused on this.
And this is a long-term trend, I guess you could say. Like this isn't going to be like a short-term trade. People rotate out of U.S. equities, they go into places like China and commodities and so forth. This is probably 5 or 10 year trend, I would assume, eh?
Yes, I mean, it will be challenged. You will have windows of opportunities to redeploy capital again. We'll have volatility just like normal markets have had. I mean, think about the opportunities you've had to invest in the equity markets in the US throughout the years. You have a few big sell-offs, the COVID crash, even 2021 arguably was another one when markets peaked. So you're going to have those scary moments in emerging markets in developed world as well, outside of the US and commodities. But I think that the trend is you want to buy those dips at those times, and it's very helpful when you identify these big trends, because you can then be redeploying capital when the timing is right. So I'm not chasing things that have moved a lot. I'm never going to do that, but I'm paying attention to markets that have had sell-offs and are having issues that are part of this kind of realm of either things that are outside of the US or natural resource assets that have these types of opportunities. There's a lot of things that are currently looking attractive, and a lot of things that don't look attractive as well that are within these markets too. So I think it helped to sort of identify these big trends, and then you can kind of think about how do you express those views more and more. And there's going to be learning curves within us as investors of what are the best places to put money in as well. I mean, this is all part of our learning curve as capital deployers too. So
on that note, I know you obviously pay attention to monetary metals, as do I, but you also mentioned you're not going to chase things. So I would imagine you're not chasing gold. Now that's not to say you don't own it. Now, was it Crescat? You guys recently bought a pretty large silver miner, wasn't it? Is that a way that you're playing this kind of theme? Is that part of the thesis?
Yeah, when we bought that mine, silver was trading at around $17 an ounce. And so by no means I think silver has gone up to the levels we think it will get to. But it was a scary moment for most that were silver investors. And a lot of people, at the time, I remember silver's, 17, 19. And then you had people come out and newsletter writers saying it's going to go back to 12. It's going to go back to 15. And I'm like, well, does it really matter if they are right and ultimately we go back to 50 or so at some point? How much can I lose versus how much can I win? The asymmetry matters at those levels, and I think people put too much attention in those moments to, maybe things can go a lot lower still before getting better, and it's sort of meaningless in my view. Yeah, I mean, there are situations like this. Oil is actually in that position kind of like that,
Yeah.
You see a lot of people saying, oh, I can see it go back to 60 or 55 or, does it really matter, if you bought it at 60, now at 50? And does it really matter, if I find the San Cristobal of oil in that front? Like, yeah, I'm interested because there's a lot of upside in my opinion. So those are interesting setups that you have every now and then that you can take advantage of it. I'm a little cautious on gold, I mean, yeah, but there's a lot of sentiment that has changed. But I also understand how undervalued the metal is over, history, particularly relative to Treasuries outstanding and all sorts of research in that front. So again, I can see the long-term play. So you don't want to get too tactical in things, in my view. I mean, I think the biggest issue of investors, not to get into that topic, but it's an important one, is to be too cute in trying to find all these twists and turns of every week. My cautiousness on gold, I can assure you that I'm not taking any action on it. It's just a commentary thing. I mean, I'm not really buy puts on gold, anything like that. But I do think there's the derivatives of gold are looking very attractive relative to gold. And that doesn't mean I'm bearish on gold at all. It just means that there's better places to maybe be putting capital into.
You mentioned something really interesting. I've heard you talk about it before, but U.S. Treasuries outstanding and gold's value, kind of that correlation. With the amount of U.S. Treasuries outstanding, how does that translate into higher gold prices? Like, what's the relationship there? I heard you talk about this, and I think it'd be very good for our audience to hear.
Yeah, I think there's a few ways, and some people try to value gold and what's the intrinsic value of gold. And gold has been used as an anchor for the monetary system for many centuries. And it is interesting that a lot of times in periods of unstable moments for currencies, you have this kind of reestablishment of gold as a large percentage of the monetary base or other ways of measuring how much money is in the system. But the money overall has found so many different channels in the U.S. economy, in particular relative to other periods, that monetary base is no longer a great measurement of how much capital is in the system has been created. So, what's the second option you have when you can look at money supply and you say, all right, well, how much gold do we have relative to money supply? But even money supply is not a great way to measure this, because money supply is hovering around $20+ trillion in the US, just to give an example. But then you look at how much government debt is outstanding. You're talking 35, $36 trillion. So what is more relevant, money supply or how much debt is an overall system there in the government? So, okay, well, it's obviously that. And so that's a broader sense of credit in the overall system, especially given how much reliance we have in government spending relative to GDP as an engine of growth. And so all these things are kind of linking to, all right, well, let's look at the U.S. gold reserves relative to government debt. And back in the 1940s or so, even before the World War II environment, we were holding somewhere close to 40% of U.S. gold reserves relative to U.S. Treasuries. And today we're about 2%. Now, I'm not here to say that we're going to go back to 40%, but I can see increasing substantially from current levels. And that kind of gives you sort of a path understanding how cheap and asymmetric gold could be relative to those imbalances that we have. I hear people saying, positive things about Doge and the efforts of the administration on reducing wasteful capital and so forth, and even conversations about, well, if we have some, meaningful cuts on spending, can we even do a dividend of of the improvement? Like, we haven't even accomplished going to a surplus. We're still increasing the debt. Like, that's the thinking here. And so, in my opinion, we're so far away from fixing the problem that, in fact, we're still exponentially growing the problem. And talking about how to dividend things already, it just sounds insane. It sounds like the lack of understanding of how deep the problem really is. And so, gold is probably going to go a lot higher. So, that's why it's completely meaningless for me to be here pounding the table and saying I should be cautious about gold prices short term. Right. So it's really remarkable that the U.S. government has opt out of this gold buying spree that we've had over the years. Gold, reserves are at a 90-year low in the U.S. and then a 50-year high in international central banks. And my question is, when is the U.S. gonna choose the moment to participate again on this buying spree? And clearly they're missing out, and they know they are. And this whole situation of gold imports, and also, what if the U.S. is buying gold and we, and not reporting that? What if this has nothing to do with Fort Knox and has more to do with just buying gold specifically and adding to the reserves in an even bigger way? I know people question, do we have the gold that we claim we have or not? What if there's a bigger agenda happening on the back of all this and people focused on Bitcoin and are we going to buy Bitcoin? I mean, it's nothing. It's $20 billion how much we own. And if we're going to buy to, grow it to a million Bitcoins, we're going to at these levels, we're going to own about $100 billion worth of it. I mean, it's nothing, I mean, what if this is masking a much bigger idea of maybe owning gold in a big way? And that's what's really driving the metal. Now, if you're really serious about accumulating gold, you don't announce to the world that you're doing it. You buy it and then you announce it, right? So that's what any smart allocator would do that has enough capital that would move the market. So those are my thoughts on all this.
I mean, let's pontificate a little bit, but what's the motivation for the U.S. to buy gold? Like, I understand the history. Obviously, I know I'm a gold bug through and through, but what would be their motivation to quietly accumulate?
I don't think there's a replacement for the reserve currency, by the way. But at the same time, I also think we're flirting with the dominance of the dollar versus other fiat currencies in a world that seems to be pushing towards a multipolar currency environment. And if that's the case, then that's a serious threat, because a lot of things have been allowed for the US government and the Fed and so forth because of this dominance and because of this reserve status. I think that this administration has potentially its best shot at fixing part of the issue, but I'm not saying it will as well. And I think it needs to get back to the fundamental point of, it can unlock a lot of value by doing better things fiscally and also through deregulation and all sorts of things. This is all great stuff. At the same time, the dollar has grown too much in terms of its dominance without having very, very small amount of backing from a true haven asset that has credible history to be an anchor for the dollar specifically. There's a reason where we're seeing executive orders making gold a critical metal again. Gold is not an industrial metal per se as copper and others, but what if it's through mining that we can maybe get gold back into U.S. gold reserves somehow? I mean, back in the early 1900s and so forth, it was really through a trade surplus. We basically went from making our trade balance much more relevant, which now is almost irrelevant today. By doing that, then being able to purchase gold with that surplus. I don't know if we can really do that today. So I'm really questioning the ways we can potentially accomplish this. But I think it's inevitable that the US, in order to restore some of that importance of the dollar versus, in such a strong push globally to a multipolar currency environment, that the US is going to have to come back and start buying gold again. And so, once that happens, gold's not going to be trading where it is. I mean, it will get over. All these guys looking at overbought indicators are going to get killed on that view, because it won't matter. I mean, it doesn't matter. Right. Imagine looking at that in 1933 and saying gold looks overvalued, and then boom, So there are moments in history these things matter, and I think we're there now. So I respect those types of analysis quite a lot, and I'm very much against short-term thinking on metals right now.
Yeah, no, likewise. Are we in the midst of a global de-dollarization? Like, there's all these theories out there that the world is de-dollarizing, or at least the eastern part of the world is de-dollarizing. There's this grand plan, a kind of a cohesive effort from central banks to de-dollarize. Is that valid, or is the buying of gold that these central banks are doing just a safety measure? What's your take? Is the dollar's hegemony truly threatened here in the next 5-10 years, or is this a much longer kind of decay and downtrend? What's your take on that?
I think there's truth in to some of that, for sure. I mean, the problem is there's exaggerations on the other side of it too, but let's talk about what I think is true. I mean, there is still buying of treasuries, but not to the same level we used to see before. I believe that that's certainly bothering, policymakers, because the US is not being allowed to really openly do the same. And so imagine being in that position, and maybe they found a way that they can do this, sort of hidden. And it wouldn't shock me at all that the US is actually the one driving gold prices higher, buying gold.
Interesting. What do you mean the US is not allowed to do the same. What do you mean by that?
Yeah, allow might be the wrong word. Well, I just don't know how you openly do that without causing the dollar to collapse.
Right.
Like if you come out and say, I'm buying gold, and I've been listening to Scott Bessent very closely, for instance, and other guys. And
big gold guy.
Yeah, big gold guy. And people come back to me and say, well, he didn't say he wants to weaken the dollar and things like that. And I'm like, yeah, he can't say that. It's obviously that he cannot say that. Trump is crazy enough that says those things, but a guy like Scott Bessent, he's aware that any trader that hears anything remotely close to that will trade it immediately and short the dollar. And so, but you also have to understand that if we want to restore growth in the U.S. are sucked so many capital outside of the foreigners that we can't suck more. This is too much. And so if you look at the U.S., the rest of the world, growth has been stagnant. Well, versus the U.S., it's been declining. But take a look at the chart of emerging markets, for instance, for the last few decades, it's been basically sideways. In order to unleash that growth again, which would help the U.S. and it would help everybody, we can't have a strong dollar. So anyways, all these things are all linked to each other. So I don't think the U.S. is allowed to, it might be the right word, not allowed to really buy gold very openly. So yeah, I'm afraid that maybe there's technical ways to do it hiddenly. I think a lot of people have very strong views about Fort Knox and all these things. And honestly, I don't think they know what they're talking about because it's none of us do. And it's impossible to know exactly what's going on. Mm-hmm. And we all have to operate under the assumption of a lot of things could be happening at the same time. The only thing I would mention is focus on what I said earlier, of which a large buyer like the U.S. government cannot openly allow that they are buying gold if they're serious about accumulating the metal, because if they do, it would cause gold prices to be at $5,000-$10,000 an ounce immediately, and it would make their task a lot harder too.
I'm going to jump around a bit here because you mentioned it and I want to talk about it. Oil. Why do you see upside in oil? The global economy seems a little bit dicey. Obviously, the tariffs with Trump. What do you like about oil here at whatever it is, $68 a barrel?
I love an asset that has less risk than reward. I believe that we are in a more inflationary era, and it's hard to ignore the fact that oil is almost the perfect proxy for geopolitical risk. And if you plot two things in one chart, of which one axis you have geopolitical risk and the other axis you have oil prices, these things are really out of whack, meaning geopolitical risk is really high, and at the same time, oil prices are very low relative to that. So I like this asymmetry on that front. And plus, you have another thing. If you're an oil producer, and let's just say oil goes down to $40 a barrel. Trump openly said that he would build strategic oil reserves if that happens. And so you kind of have a big buyer saying there's a floor here. He also claims that he doesn't want oil prices too high, but does he really have that type of control over where oil prices could go? I think he's got more control over the floor than the ceiling. That could be very well reflected in the business that is producing oil itself. And so I think there's a reason why Warren Buffett is buying oil companies. And he's got a pretty sizable position in Chevron, Oxy, and I think that one should take note of that. I'm kind of crazy, maybe bullish energy stocks relative to even our own team at Crescat, and I've been maybe right on the equities, wrong on oil, but I really don't mind being wrong necessarily. I think that, of course, I mind in terms of learning and so forth, but at the same time, I continue to think that it looks really opportunistic to be taking a position in those things. And you can find oil companies that pay dividends, high dividends today, and others that have really high quality assets that could be very strategic for the US economy. And I don't believe that you can just drill as much as others do. And clearly production cannot grow as much as has been feared off in markets. And maybe if you notice, there's a conversation change, especially from Bessent regarding that, of which he used to talk about increasing oil production to a certain number. I think he talked about 3 million barrels a day. And now he's talking about how that is actually oil equivalent, which includes other things. It's kind of interesting how those messages have shifted. And clearly that's because we can't really increase oil production that quickly. And so how much control they have over oil prices is a good question. Then you look at gold to oil ratio, second largest level in history. And knowing that in the 1970s and other inflationary eras, oil was one of the best performing commodities out there, I can't help but be bullish. So I'm structurally bullish oil, and when sentiment and positioning is so off, I can't help but also have a contrarian view on it.
Potential environment of a weakening US dollar. Yeah, I know, I agree. Lastly, because I always like to look at possible situations where themes can be upended. So if you take the Trump tariffs, for example, I mean, just today he came out and said, well, or yesterday, we'll be flexible and maybe it's a tit for tat, blah, blah, blah. The language changes every week. What do you think about these tariffs? Do you think Trump's going to follow through with them? Or do you think this is just all part of some big negotiation?
Both. And there's lots of thoughts on that, but try to keep it short. I think Trump is definitely serious about this, especially the reciprocal things that he said. I mean, Bessent has said this. Trump's favorite word is tariffs, and his second favorite word is reciprocal. And so I took note of that. I think it's going to happen. But at the same time, it's important to notice that maybe not as relevant from that standpoint, because I'm sure you've seen those charts of showing tariff revenues relative to GDP today versus history, and how history was much higher and today is a lot lower. And now we're talking about this and just going to be as high as it was back then. The difference is that trade balance today is drastically less significant than it was back in those times. And so the US was much more exporting an importing driven economy than today. And so tariffs may not have as much of an impact as it used to be back in those days. I think that has not been something that people have really focused on, that should be, maybe more, emphasized. And the second thing, the setup policies are quite bearish, actually, right? I mean, you have tariffs is short-term negative for markets. Could have other implications later on, but certainly more short-term is negative. But I think that what trumps that is really the immigrational policy is even more important to me. Immigration policy kind of hits right at the heart of what drives growth in an economy, way more than tariffs. And so the fact that we're reducing...
Explain that. Why is that? Is that to do with demographics?
Yeah, absolutely.
Right.
There's three types of things, in my view, that creates growth. One is when you're at the right time of the cycle, natural resources. The second is technological advancements, which the U.S. has done, incredibly well. Mm-hmm. One of the main reasons why the U.S. has done so well. And the third is demographics, which could be growth of population, young demographics, and so forth. So you got obvious one is India, that has benefited tremendously from that. You had China in other years, and now on the other side of this, in other decades have benefited, and now it's having issues with this. But you have this sort of moment now where, and again, it's not a political opinion at all. Like, I'm trying to completely separate myself from the right or wrong side of this. But the last few years, we've seen a lot of increase in population in the U.S., which drives housing market and drives the labor market. So think about all that. Now we're trying to reverse all that, right? We're saying, all right, let's remove all these people, like it or not like it, and being right or wrong, that will have an impact on the economy. Like, why are we not talking about this more? Like, this is going to have the removal of people from the deportation, they're illegal and so forth. That's going to have an impact on the economy. Bottom line, I noticed something that was very important. If you look at the job openings, it's starting to rise again. And it was not a very good report recently. And you look into that report, the numbers that were worse was actually coming from construction. Well, that makes sense. And then the numbers that didn't hit yet which is remarkable, is the government labor has been unchanged. So we haven't really seen the impact of people being fired and so forth on the government side. All this stuff concerns me a lot, because I do think that it's going to create a big change on near term here and medium term on economic growth. And it's been one of the biggest things that probably drove growth recently since that crash that we had in 2021. It has been, one way that the Biden administration used to sort of address the downturn in the economy at that time was to kind of open up the immigrational policy and increase population in a big way. And that created a huge change of things. Inflation came back and all these things. And so it's going to have an impact for sure.
Demographics is one of the biggest things that keeps me up at night, so to speak. So I invest in real estate, been doing it since I was young. And when I look at asset values and I think about, okay, look at the fertility rate in virtually anywhere in the Western world, even parts of Asia and so forth, it's so low that without immigration on a pretty large scale, at some point the population is going to flatline or even decrease. We're already seeing that in places like Japan and China and South Korea. To me, demographics is the biggest threat to hard asset values. Now, what do you think about that? How do you feel about real estate, for example, if we're talking about like a 10-year time horizon, given the anti-immigration sort of sentiment that's brewing in the West?
I think that's going to change personally. I think we may see that actually improve, over the next 10 years, may see a big change in that front.
On which front? The sentiment or people having kids?
People having kids. I mean, it's just
really
talked a lot now that this is a problem and people are taking note of it. And maybe it's just my circle of friends, and I don't think it's showing on the data yet, but I wouldn't shock me that, the fact that we've gone so much to one side maybe could change. But also, one thing it's hard to be bearish on long-term in real estate is if you are of the view that you can have a bullish environment for hard assets, notice that real estate really outperforms the S&P 500 over a long term. During inflationary eras, the 1970s is a great example, 1940s is a very good example as well. And it has been underperforming for a long time. And I think that we could see another decade of real estate outperforming the S&P. Now, it doesn't mean that if you put into buckets of hard assets, real estate's probably not the most asymmetric and the most interesting. I had the chance to meet with Sam Zell one time, which if you're in the real estate market, I'm sure you know who he is.
Yeah.
And before he passed away, I asked a lot of questions regarding this. And he was very openly talking about the issues with construction and how he views this kind of path of home builders being a real long-term thing. And then you see, Buffett also is invested in some of that. And you have David Einhorn owns his own property developer kind of private business. And now Peter Thiel coming down and saying, that we can see a catastrophe on that. And a lot of people took that on thinking, it's going to be a crash of the house. No, that's not what he said at all. What he said is, he's concerned about the fact that affordability of housing is a problem. It could get even worse if we don't let people, build things. And so, I wouldn't get in front of that. Like, I don't know, but I think there's clear understanding that, it's hard to get in front of hard assets in this environment. So let's just say you're just a 9-to-5 type of person working all day long and have nothing to do with investments. Are you better off owning a 401k or putting your capital into a house? I'm going to say something very maybe unpopular, but I would say you're better off putting money into a house.
Interesting.
The other thing is, if you want to fix the inequality issues, which seems to be a very important focus here, how do you do that? I did this research back in the days and changed my way to my personal finances. I learned that the bottom 50%, 80% of their assets was real estate. I remember my in-laws were, first time I made some money, they came up to said, hey, you got to buy a house. That's what we do in America. Imagine a Brazilian, my wife is American. And I was very against that because I wanted to invest in financial assets. Because when I looked at the first percentile, 90%, 99% of their assets is in financial assets. And I was like, what if I act like I'm in the first percentile, even though I'm in the bottom 50 percentile? Like, how do I do more of that? And it worked for me. I mean, it certainly got me at a much better position than most of my friends that did the other thing, right? Which was buying what was perceived as the right thing, put most of your capital into buying a house. So I did that, and I think it worked for me, but knock on wood. But, in order to fix the issue moving forward, I do think that the U.S. is very much aware that the fact that you have most of the population on the bottom 50% still own, that's what they own. I mean, it's real estate. And I would be shocked if they cause that market would fall apart. Like, I think it would be easier to see the S&P 500 not doing very well for the next 10 years than the housing market. So it would be my first place to point out what the risk is personally, and think that there's definitely a push towards helping the housing market as much as possible. So
that's a great breakdown, Tavi. This conversation's been awesome. We've talked about all the assets that I wanted to cover. Before I let you go, where can our viewers find you online? Tell us a little bit more about what you do at Crescat.
You can find some of my work on X at Tavi Costa is my handle, or on LinkedIn. I post things there, same things there. You can just look for Tavi Costa. At Crescat.net is our website. You can find a lot of our research pieces there as well. What do I do and what does Crescat do? I'm more involved on the macro front of what we do there at Crescat, but we run 3 different funds: a global macro, long short, metals and mining focus fund, which is very much precious metals focused, but there's a lot of base metals in it as well. The whole point is to deploy capital in what we think it's the cheapest part of the mining space, which is, in our view, exploration, and remains to be a very inefficient side of the industry. So we partner with the geologists and been looking for unique ways to create a portfolio of activist role in different types of companies to improve our odds of getting things right.
Junior exploration, I mean, I obviously am pretty focused on that world as well. I mean, it's obviously very high risk, and the greatest enemy is time, dilution, right?
Yeah.
How do you manage that, especially on the exploration side?
It's been the case for many decades. They're not in the business of making money. They're in the business of diluting and then try to create value through exploration. The failures of this part of the industry have been outweigh the winners, but the winners have been, really remarkable. Majority of the billionaires in the industry have made their capital really buying properties that found major discoveries and became billion-dollar companies, and they own a big chunk of it. Today, there's a case to be made where you can create a hybrid venture capital kind of style of portfolio where you making a lot of bets on things that could become those major discoveries, own 20% of them, direct the capital to be drilled in places that you think have the higher odds to finding that. I'm not a geologist, that's why I work with geologists. I don't think there's enough of that being done. I'll give an example, like St. Cristobal. Most of the value we've created since we purchased the asset wasn't really through the fact that metal prices have risen and we made money on free cash flow. It was the fact that we redeployed most of that money into exploration and ended up finding a lot more metals. And imagine you own a mine and you extend the mine life just because you found more ore by 5 to 10 years, and then you find another discovery nearby that increases that by double that amount. Imagine how much value you just created by putting maybe $100 million into growth, So I just think that we've completely ignored growth versus, shareholder-friendly policies just for the sake of capital management. But playing offense in mining can be really important at times, and I think that that's the case now. And we've been trying to do what we thought the majors were not doing through St. Cristobal. But at the same time, I do think that there's a very great opportunity I'll give you the great example. When companies put out results, sometimes you see a company down 20% on a result and you're like, oh my gosh, what's going on? Forget about the share performance right now. These results are great. I mean, this is, if you just think about the odds of finding a discovery has gone up drastically, and the market just doesn't know how to interpret things. It's been my way of understanding this, and it's extremely inefficient. So if you're taking the long-term kind of view on this, you can buy the assets 20% cheaper now and keep accumulating it until you actually show the world that you really made a new discovery, and now you're really onto something, and then everyone would agree with you, and now you own a huge chunk of it. So there's a lot of winning lottery tickets out there, in my opinion, that people are ignoring. Yeah, I mean, maybe I'm very wrong, but that's been the some people say, oh, these guys have been very lucky, they find a discovery every year. Are we being lucky, or people are just not looking at them and just saying exploration is not worth our time and there's just dilution? Yes, there's dilution. This is very much the case, but how much dilution do you need for how much value can you create? Let's say you dilute $10 million in a 30 million market cap. It's a very large dilution, but what if you can go from a 30 million market cap to 200 million on the back of that? And it's not real not a real problem. And so that's the type of opportunity you can have in a bunch of these bets that could become those big discoveries one day. So
yeah, I don't believe in luck in exploration investing. I think it's a battle of attrition, to your point. Just one more thing. So if drill results oftentimes aren't getting the returns from the market that are expected, what is the catalyst for these exploration companies where the market starts to realize, oh, there's value here? It's got to be more than a resource calculation. Like, where's that trigger where the market starts to understand what an exploration asset could be?
Well, I think it's not that it's not rewarding. It's only rewarding those exceptional discoveries, and the normal, size, which are incredible discoveries, have been just dismissed potentially. So companies that put out, like, it used to be the rule of thumb, right? If you follow mining stocks that, you put out greater than 3 discovery holes, which, what's the definition is, you can look at the grams per tons times meters, and if you get a number above 100, it's a discovery hole. We have companies that have put out a lot more than that, 5, 7, or companies that put out 1 discovery hole and the market just ignores it. Usually if you have that, it's sort of the odds of finding more, it's pretty high, just statistically speaking. And so, extraordinary type of discoveries have been rewarded very well, but the other normal ones have not. And what changes is the market understanding the need for the big companies to replenish their reserves again. And why hasn't it done that? I think there's maybe a few reasons. To create an M&A, you need 2 things. You need even companies that need to be making money, or the share prices need to be a lot higher because that's their currency. And so they've got 2 types of currencies, and both of them are going up recently. You have free cash flow improving, margins improving. Maybe we're hitting what I call the golden age of mining type of margins. And at the same time, you're also seeing, their share prices starting to reflect some of that. Some of these companies, as GDX not too long ago just hit a decade plus weekly high. That those are important signals. Companies may dilute a little bit to then use that as a currency to buy other things. And we've seen M&A, but mostly in the mid tiers and seniors, but not really coming down to the bottom of the side. And the stats that we do, are companies that we invest. If you look at how much drilling they're doing, it's way more than all the majors combined in terms of how much they're budgeting for exploration for the next year. How much value can we create if they keep doing this, and we're going to be finding stuff at some point, and it's going to be pretty significant, I think. So, and those guys are going to have to come in and buy at a higher value. So it's going to be the name of the game, in my view.
Well, Tavi, this has been an awesome conversation. We touched on a lot of different things. I want to thank you. I've enjoyed it thoroughly, and I know our viewers will appreciate all your wonderful insights today. So thanks for your time, man.
It's my pleasure. Thanks for having me.